Your home loan is bad debt. It's just the same thing as paying rent. The faster we can get good debt, the faster we get wealthy. Your primary asset is you. You're your primary asset. And we want to increase our debt. We want more debt. Isn't debt bad? Isn't that what we were taught? No. Welcome to the Passive Property Investor Podcast, where I teach you how to stop trading your time for money with property investment. I'm Jerry Parker, your property investment consultant. Let's dive in. Hello, property investors. Welcome back to the Passive Property Investor Podcast. We're going to be talking about something today. It's basic. It's good debt versus bad debt. What is that? What is bad debt? Well, why isn't all debt bad? Isn't debt bad? Isn't that what we were taught? No, there is good debt. But what's bad debt first? This is the debt that you're seduced into having. This is the evil debt. This is the debt that when you buy your jet ski with, you go borrow money and buy a jet ski. The jet ski goes down in value to zero, goes to nothing. And so that money you put in there just disappears. Hey, and if you don't have it paid off by the time it's finished, it doesn't matter. You still have to pay it back. Your car is bad debt. That's not good debt. Never borrow money to go on a holiday. That's bad debt. Credit card debt, bad. And that's not a really high interest rate too. That's like the worst debt. If you're trying to get rid of your bad debt, get rid of that one first. What else is bad debt? Controversially, but this is true. Your home loan is bad debt. It's no good. It's non-tax deductible interest on your home loan. It slows you down. It's just the same thing as paying rent. So it doesn't help you. So let's talk about good debt. What is good debt? Good debt is where you go, buy money, what we've been talking about. You borrow money from the bank and you put it into an asset that goes up in value and preferably faster than the interest rate that you've paid. That's good debt. That's called leverage. And you're leveraging the bank's money to put into assets that continue to go up in value. That's why that's called good debt. We look at it as passive property investors as it generates that equity that we can access and continue to access more and more good debt over time to continually put into assets and like houses that go up in value. So I hope that's clear on what's the difference between good debt and bad debt. So now, how do property investors use this just to continually to get ahead, or to actually a few hacks that you use to help you get rid of your bad debt? Well, we're using the debt to build more assets and build more equity. But you might have this strategy where, you've got your home loan and you can set up an offset account against your home loan. No, your home loan is bad debt. But we've bought an investment property over here on this side, and all the rental income goes into the offset account of our home loan, thereby reducing that bad debt, that bad non-taxable debt, tax-deductible debt. And so as we buy more properties, we keep putting the rental income in there, and it builds up a balance over time, and it just slowly erodes our cash, slowly erodes our bad debt. We will have to transfer it out to make our interest payments against the property development, of course, but it's just a strategy that we use. And then you can attach a credit card to all the payments that you make, and that'll give you another 60 days worth of money stacking up against the bad debt of your home loan. It's a typical strategy that capitalists use as a form of money to help you get ahead. Well, let's say you're young and your parents said, "Oh, you've got to buy your house," just like they did, and they just slowly over their 30 years paid off their mortgage, and they've done quite well. Their property has gone up in value a lot. But, property prices are high now, and so you're waiting to build that deposit up so you can buy your own home and live in your home. And why is it? That's not passive property investing, and that's might not help you make money as fast otherwise. You're going into that house, you have the bad debt, and what you're paying against is just rent. There's no difference in making a mortgage payments in your house and rent. And typically, it's hard to live where you want to live too, because you're forced to live where you can afford to live. And it's that getting pushed out further and further away from where you work or where you want to live or where, all your people are. And so it kind of affects your lifestyle a bit. You spend more time traveling and you're not your full self. You're kind of struggling a bit just to hold on to this house, and you're only paying rent there anyway. So it's not the greatest strategy. The rent investor strategy is much better, especially when you're first starting out, because you take your assets and you're buying investment properties, and then you rent where you want to live, and you rent close to work. You rent with a view where you're proud to live, and it's driving you forward. Because remember, you don't have a lot of assets. Your primary asset is you. You're your primary asset. And if you do live where it makes you feel stronger, makes you feel better, makes you drive you forward, closer to work, closer to your people, your asset will make more money. But if you're out in the boondocks living in this house because you feel like you're supposed to live, own your own home, well, that might not help you. So build the asset of yourself personally. Use the equity that you have that you can afford and buy investment properties in areas that are going to go up in value faster, and build your wealth that way, rather than just owning your own home, because it's not necessarily the best way to build wealth. It's a good way to preserve wealth after you've made it, but it's not a great way to build wealth initially. Become a rent investor. I mean, you rent, but you own investment properties. That's the better method. Quick summary of good debt, bad debt. Avoid bad debt like borrowing money to buy a jet ski, to buy a car, to buy any toys, to buy holidays. Bad debt. Your home loan is bad debt. It's just like paying rent. What we're about as passive property investors, capitalists, we're trying to build assets. You are an asset. Live where you feel strong. If you have to rent there and then become a rent investor, it's better than living in a place that makes you struggle because of the location or the quality of the property. Don't do that. Rent there. It's respect yourself as an asset. Build the asset that way. Become a rent investor. There's nothing wrong with that. And we're going to use the good debt of buying more assets that go up in value. And we want to increase our debt. We want more debt. The faster we can get good debt, the faster we get wealthy, because we're using this leverage to, we put down 20% deposit, 5 times that is what the debt gives us in assets. And the assets go up in value 10%. Well, we've just increased our value of our wealth creation by 50%. And that's why property investors are so wealthy. Thanks for tuning in to The Passive Property Investor. If you enjoyed this episode, the best way to show your support is to give a 5-star review on Apple Podcasts and Spotify. Make sure you subscribe to the YouTube so you don't miss a single episode. We're on all social media platforms, so feel free to connect with me there. And if you're having specific problems making your first investment or building your portfolio, maybe you don't know which location to invest in, how much you should invest, you're worried about who to trust, reach out for me down below. I will have the answers for you. Don't hesitate. See you on the next episode.